Hello, and welcome to the Policy on Point, a discussion with policy and quality control experts about rental and employed fluctuating income. Before we get started, I want to go over a few housekeeping items with you. All lines have been muted upon entry and will remain on mute to prevent interference. This session is being recorded and will be available on the Freddie Mac YouTube channel. If you have any objections, please disconnect now. Furthermore, if you have any questions, please enter them in the Q&A box by clicking the three dots located in the bottom right-hand corner of your screen. We will pause for questions at the end of this call. With that, I will hand it over to Amanda Zlato, Quality Control Director at Freddie Mac. Amanda, the floor is yours.
Welcome, everyone, to Freddie Mac's Policy on Point webinar series. My name is Amanda Zlato, and I am a Quality Control Director in Single Family Risk. I have been with Freddie Mac in the Quality Control Department for 14 years and in the industry for over 20. Here with me today are Matthew Pugliese, Rachel Rodriguez, and Mary Simon. In a few moments, you will get a chance to meet them and hear about their topics. In this session, we will be covering rental income updates, along with corresponding application and loan scenarios, as well as employed income calculation specificity, along with some corresponding examples. As we continue this webinar series, I'd like to share with everyone the goals we set out to accomplish along the way, to give concise overviews of critical policy changes, and to share best practices, examples, and expert insight into what these changes mean for you. Now, let's meet the team.
Thanks, Amanda. Hi, everybody. My name is Matthew Pugliese, and I'm a Quality Control Manager. Been with Freddie Mac for about the past 7 years, and in mortgage operations for about 20. Currently, I'm responsible for managing a team of QC underwriters and overseeing many aspects of our QC functions here at Freddie Mac. I'll now turn it over to my colleague, Rachel Rodriguez.
Thanks, Matthew, and hello, everyone. I am Rachel Rodriguez, and I'm a Credit Policy Senior here at Freddie Mac. I've been with Freddie Mac for 5 years, and I am on the credit policy team that works on guide updates to credit, asset, and income underwriting requirements. And I will now turn it over to my colleague, Mary.
So it appears that I was talking with my mute button on, everybody. We're starting off grand. This is Mary Simon. I work in the credit policy department with Rachel. I am a credit risk business lead, and I work on the research and development of policies for matters related to credit risk with a primary focus on income, which we will be talking about in a little bit. Thank you. Amanda, back to you.
Thanks, everyone, for taking time out of your busy days to join us. Rachel, let's get back to you to get us started with rental income.
Thanks, Amanda. Today, I am going to review 6 updates that Freddie Mac made to our rental income requirements with the October Bulletin. These updates are effective for all loans with settlement dates on or after 4/1/2024. I have grouped these updates into 3 categories, and the first category is updates we made to our documentation requirements for 2 months receipt of rental income when a lease is used for verification. This was a seller-driven request to allow receipt of the security deposit plus first month's rent to meet the 2 months receipt of rental income requirement. We have added this flexibility to the guide because receiving 2 payments does meet the intent of our guide, which is to see that the funds are being received. And in scenarios such as a conversion of a primary residence, the timing is condensed and a security deposit plus first month's receipt of rent would be a more reasonable scenario to document. And then with the second update, we have specified that the documentation requirements for receipt of that rental income must evidence that the funds have been deposited into the borrower's account at a financial institution. or into a third-party money transfer application account that is owned by the borrower, such as Venmo or PayPal. We made this update because we were seeing various forms of receipt that didn't always evidence the funds had been received. And we can move to the next slide. Our next category of updates pertains to leases. We removed the requirement that a lease must have a minimum original term of 1 year, which was also a seller request that is effective for both our general rental income requirements section and for rental income received from an ADU. Here, I would like to note that this does not waive the overarching requirements for stable monthly income. We also added language to our lease requirements that details when it is acceptable to have a forward-dated lease. With this update, we specified that when a lease does not begin until after the note date, the income is eligible to be used as long as the monthly rental income payments begin on or before the first mortgage payment due date. We do have a history of having a tolerance in this area. For instance, when rental income is being used on a conversion of a primary residence and the income is derived from a lease that does not yet start. It is acceptable if the payments begin in the near future. And with this guide update, we are limiting that to before the first mortgage payment due date. And then for updates specific to rental income from an ADU, we removed the requirement that one of the sales comparables be rented. We did this because appraisers found this requirement to be very difficult to verify in the market because many times a comparable sale will have an ADU, but the appraisal may or may not indicate if the ADU is rented. And whether or not an ADU is rented is typically not public information, and because the ADU is valued as part of the entire sale, rented or not, removing this requirement does not impact the sales comparison approach or ability to establish the property value. This update does not exclude the requirement that the ADU rental analysis must include a rented ADU. And then the final update is a restructure to our ADU documentation requirements for rental income to be used on no cash out transactions. And we made this update just to emphasize our existing requirements that tax returns are always the preferred documentation. We received a few questions regarding if tax returns are required in this scenario that brought to our attention an opportunity to be a bit more clear with our existing requirements. So with that, you can see with these updates, we have a little bit of everything. Next, Matt and Amanda in Quality Control are going to provide you some examples of loan scenarios where these updates apply.
Hello, everybody. Amanda and I are going to provide examples of some deficiencies we see here in QC that could prevent rental income documented with a lease from being utilized. So here on this screen, we're going to start off by reviewing our guide section that outlines the documentation that is required in addition to the lease. Now, this is for a subject property refinance or any non-subject property that was purchased in the current calendar year or placed in service in the current calendar year. This is outlined in guide section 5306.4a, which is reflected there on the right side of the slide, as you can see. Now, we're currently seeing many purchase transactions here in QC where a borrower is going to be retaining their former primary residence and convert it into a rental property. So in these types of scenarios, when using the rental income with the lease for the former primary, the documentation requirements outlined here in the guide section must be met.
So Matt, what would you say is the most common defect seen in QC that would prohibit us from using the rental income on a lease agreement?
Yeah, good question, Amanda. Yeah, I would say it's files submitted with only the lease and no other documentation to support the rents. The rental income from the lease is needed to qualify. The loan submitted, it's either missing a comparable rent schedule or it's missing the evidence of the receipt of funds that's outlined here in the second bullet. And without that documentation, the rental income from the lease can't be used to qualify, and it could have a material impact on the overall debt-to-income ratio.
Okay, so in the example above, the borrower's bank statement has a $3,500 deposit, a copy of the canceled tenant's check for $3,500, and a lease for $2,000 a month rent with a security deposit of $1,500. Would this be acceptable verification, Matt?
Yes, that actually would be considered as sufficient. Since we have the first month's rent and the security deposit, it would satisfy the requirement per the Selling Guide Bulletin 2023-19. So the previous guidance was to obtain evidence or receipt of the first 2 months rent, but now we have the first month and the security deposit. So yeah, that'd be good, Amanda. Okay, so moving on here, I have another example here I want to share. So in addition to not receiving any documentation to verify the rental income on the lease, there's also times in which we receive documentation, but it may not be sufficient. And so here we have an example of insufficient documentation for the receipt of the funds from the lease agreement. The lease excerpt, which reflects monthly rent of $18.50 per month. We also have 2 receipts there, rent receipts showing $18.50 being paid from the tenant for the address that's reflected on the lease.
I see we have 2 months here, Matt, April and May, both for $1,850, which matches the rents on the lease agreement. So what else is needed to document the rental income?
Yeah, Guide Section 5306.4A and the Bulletin 2023-19, Amanda, they require evidence that the payments were cashed or deposited into a financial institution to meet the documentation requirements. Now, cash is acceptable, but a handwritten receipt on its own is not. So if the borrower provided bank statements for April and May showing $18.50 being deposited, now that would be acceptable. And the rental income would be able to be used for qualification in that case.
That makes sense.
So yeah, in this slide here, I want to provide an example of what to look for on a comparable rent schedule, which can also be used to validate the rental income when using a lease agreement.
When rental income is validated on a Freddie Mac Form 1000, what is the key data to be analyzed?
Yeah, I highlighted the estimated monthly market rent for the property as it reflects here as $15.50 per month. So if we have a lease agreement for the property reflecting monthly rents being $15.50, then the rents on the lease would be valid, and 75% of the monthly rental income reflected on the lease, it could be used to qualify.
So Matt, why can only 75% of the rents on the lease be used?
Oh, that's to account for the vacancy factor. So things may not always go as planned for the landlord for a multitude of reasons, and the 25% vacancy factor is to account for that possibility.
I see. That makes sense. Thank you, Matt.
Okay, so now I have an example of a lease agreement provided for a newly executed lease on a departure residence conversion or a newly acquired rental property. So in this case, the subject loan closed on April 10th, 2023, and has a first payment date of June 1st, 2023. So now, Amanda, per Selling Guide Bulletin 2023-19, would this be an acceptable lease agreement?
No, I don't think it would, Matt, because the first rental payment on the lease, August 1st, 2023, is after the first payment date on our mortgage of June 1st, 2023.
Yeah, that's right. That's right. Yep. One more question here, Amanda. What if on the same mortgage, we had a lease with the first rental payment being June 1st, 2023, and the term of the lease was not for 1 year, but rather a month-to-month term?
Well, that would actually be acceptable since the first rental payment is not later than the first mortgage payment date, and Selling Guide Bulletin 2023-19 removed the requirement for a lease to have a minimum term of 1 year.
That's correct. Yep. And the rental income from the lease would be eligible, provided it was confirmed with the documentation we've been discussing. For example, bank statements from the borrower confirming deposit of the first month's rent and security deposit, or comparable rent schedule supporting the monthly rent. Okay. So I'm going to wrap it up here for this rental income segment. Have some key takeaways here on the screen. Just want to discuss briefly. So always need to make sure you have more documentation than just a lease agreement. We see this as a common missing document in QC where we received a lease agreement, but no other documentation. Venmo, Zelle, PayPal, or other third-party money transfer apps are very common now in which tenants pay their rent, and it's acceptable provided there is the documentation from the borrower to confirm the receipt. 1 month receipt plus a security deposit is now acceptable in lieu of the 2 months rental payments. And finally, a comparable rent schedule is acceptable and should support the rents on the lease agreement. And a Form 72 is also acceptable if the property is a multi-unit. So now I'll turn it over to Mary.
Thanks, Matt. Hi, everybody. So we're going to go over what we just recently published in November, and it was primarily focused on fluctuating hourly employed income and income calculation specificity. The next slide. Before we start, I wanted to give everybody just a quick bird's eye view of the topics. There was a lot of information in that update, but it's not overly complicated. It was just more of a concept to put out there to assist in the calculation of fluctuating hourly. And these are all the different topics that were hit while we were doing that. So just take a moment, kind of run through there. It'll kind of level set what we're getting ready to go through. I thought that might help before I started talking and getting into a lot of detail. The bullet number is on there. It's 2023-22 if you want to link to it real quick. Anyway. Also, see at the end, we published FAQs for you, and there is a link to those FAQs in that bulletin. And we will also go over some more information on FAQs for you in just a minute. Next slide. Couple of housekeeping items. The effective date. So we made the effective date 5/1/24. A lot of the times when we make an effective date that far out, it's usually because requirements are changing. We're giving you time to get those requirements into your processes. And that wasn't the case with this one. These were not requirement changes for the most part. They were added guidance. It was a lot of underwriting guidance put in there, but a lot of you requested that we give you some time to take a look at it, absorb it, get it into your processes. So you can use it right now if you want to, or you can take some time to put it out there for your folks, whichever works for you. But that's why it was so extended. It wasn't because of a bunch of requirement changes. In viewing the updates, now I thought this might be helpful for some. I know it was helpful for me the other day. When we do these future updates in both all regs and in our digital guide, when you open our guide, you're going to see the requirements before we ever announced anything because they're not in effect yet. And I wanted to make sure that everybody who was interested in these knew that when you're in the digital guide, in this slide, see in your top right, see the second little yellow box? That says current. And when you're in the digital guide, if you just click on that, it says current or it says future. And if you want to go to the guidelines that we're talking about, you could click future and that'll come up for you. That may seem really basic to some, but I've talked to folks internally who are like, oh, I didn't know that was there. So why not? We'll share. And then what's the other thing? I got this just the other day from one of our sellers. They asked for a red line. And I know a lot of people are using the digital guide and you really can't, even when you go in the future, you don't know exactly what changed. But if you are really interested and you're doing a stare and compare, depending on what you do, you can go into all regs. And in all regs, the new text shows up in green. And that's that second screenshot on your bottom right. So just a heads up for anybody who wasn't aware of that, hadn't used all regs in a while, the updated text for actual language change does show up in green, if you're curious. Next slide. Can we switch? Yeah. And I thought it would also maybe be helpful for some, the FAQs. So stable monthly income FAQs. We had a number of FAQs out there. I want to say maybe 4 on different topics. So last week when we published our bulletin, that was not the income calculation bulletin. That was a December's bulletin. But there was a link to an updated FAQ for the 10-day PCV topic. But also in there, we took all of our current income FAQs and made them into one web page. And it's designed to where you can go by guide section. And then if we have FAQs on a topic in that guide section for income, they'll all pop up for you. And that's the top right screenshot on this slide. We have links to the bulletins in here for you. And there is also, I believe, a link coming in the chat to the FAQs if you haven't seen them yet. And this is just more of a heads up. I would recommend those of you that really need this information to do your daily stuff like underwriting, go ahead and take a look at those FAQs, and hopefully you'll find that helpful. We also did a lot of FAQs specific to the employed income topic when we published this topic in November. So there's brand new FAQs out there for that. Next slide. So now we're going to get into the actual updates as to what we did. So for those of you that have already read the updates and you're familiar with them, this is just basically an overview of what we did. For those of you that haven't had the time to go through and read the guide, hopefully this will prove helpful for you. The written income analysis. All we did here, that's an existing requirement, no change. And in the intro section of income, which is 5301 in our guide, there was a sentence in there that written income analysis is required, and it was baked within a paragraph. Some people do it all the time, and others hardly ever do it. And the point of a written income analysis is when a file is going to secondary review, whatever secondary review that may be, whether it's yours internally, whether it's our QC, whether it's something else, if you've done a good write-up, and especially with income, because income, it can be so, you can't go out with a couple of sentences and do income. There's so many different scenarios out there. So a lot of the times it calls for a little bit, this is how I calculated it, this is why I thought it was okay, and why I thought it was stable. That write-up goes a long, long way. I've been told so many times by our QC department that when they have a good write-up, even when the income's getting a little quirky, that those deals are usually okay. It's the ones that are without it, and then somebody else has to come in behind and go, okay, so what do we do here, and what did they do, and then things start not matching. So please do your income write-ups. What we did right here was we pulled it out of the paragraph. It was mainly a formatting exercise, and then gave some more information. You can see with that little green arrow, this, I don't expect you to be able to read this, but the little green arrow shows you the bullets, which basically give you a summary of what an income analysis write-up would look like. Okay. The next one, employment history requirements. This is a small update. It's a positive one, I think. I wouldn't imagine that we'd get a ton of volume from it, but for fluctuating hourly earnings, there is a history requirement in place, has been for a while now, where you need to have a 12-month history of fluctuating hourly earnings, whether it be all from one employer or from a combination, current, previous, but you need to have a 12-month history of earnings so that income can be averaged, because it's going up and down. You need somewhat of a history. It's not like salaried income where it's a pretty straight up calculation. We saw a couple of deals that kind of prompted us to do this. Basically, all these updates were prompted by your feedback. Pretty much behind every single thing we did in here, there was feedback related to it. And on this one, you could have a borrower who's been salaried for a long time, and for whatever reason, they move to a very similar position, similar industry, but it just so happens that they're being paid on a fluctuating hourly basis. If everything foots, similar job, the income level's consistent, it makes sense to move forward with that deal, I think. So we open this up a little bit to where you can do that, and the requirements are displayed here. One thing I should call out here is that second bullet. It says that had an income level consistent with the current income level. When we say consistent with the current income level, based on the income trend analysis, and we refer you to a section, pay attention to that one, please, because in the section, 5303.4C, that's our income calculation area. And that will tell you that consistent is income that's within 10%. Your degree of fluctuation is within 10%. So if you have a deal where the income has gone way up or way down, that's not going to fit within this requirement. Next slide. The next spot we hit was earnings types. So in our guide, and I believe there's a slide that's right after this one we'll look at in a minute, we have a whole section on earnings types. And when we say earnings types, and I know it's not across the industry that this terminology is used, but you have salaried and you have base non-fluctuating, who perhaps are not salaried, they're non-exempt, but they're also based on fluctuating. We detail, and you calculate that income one way. Then you have fluctuating hourly and you calculate that income another way. Everybody probably knows that. So we tell you what is considered to fall within these buckets, because if we start off by calling somebody based on fluctuating earnings, and then we proceed with the calculation when in fact they are fluctuating hourly, everything's wrong from the start, and that's going to cause problems typically, often. So we went ahead and we updated this section. We were asked for more expansive definitions on what this stuff was, especially where fluctuating hourly was concerned. And we were asked for examples, so we gave them to you. Can we flip to next slide for just a sec? I want to show you guys the actual guide language. I think sometimes it helps to put eyes on something rather than have me talking consistently about it. I'm going to be quiet for a minute, give everybody a chance. This is the fluctuating hourly employment earnings section of the earnings types. Those two examples in bold are the examples we added. Seemingly very simple. Not all of this is not hard. So if it goes up and down, it's fluctuating hourly. But go ahead and take a look at that if you would. So it's not hard stuff. It's just really basic, but that's when I say it's more guidance than it is requirements. That's what I mean. We just enhanced these sections to speak to people more clearly. Can we flip backwards? Thanks. I believe that's it. Oh, one other thing I wanted to call out here. So what we just looked at, I did not include the base non-fluctuating portion of the guide. You'll see that when we go through some of the QC stuff. But I did want to call out that we added the words exempt and non-exempt, and we gave an example. We had some people who were saying that they were under the impression that if the earnings were not exempt, then no matter what, they were fluctuating hourly and you had to average, and that's not right. More often than not, non-exempt is probably in the fluctuating hourly earnings type area, but not necessarily all the time. So we wanted to make sure that everyone was clear on that. Make sure that those earnings aren't going up and down, but if they aren't, and like the best example would be somebody who gets overtime. So no matter what, you're working every week, your employer expects you to be there every week, same exact hours, and sometimes you're working overtime, so your earnings are going up and down only because of the overtime. That would be a classic example of what would fall as a non-exempt within based on fluctuating. And then you can go on with the more simpler income calculation. So I guess now we're ready to switch to the slide after that. Yep, thanks. The next piece that we did, and this was the biggest part of all of it, was the income calculation. And again, with a focus on the fluctuating hourly, we went out before we started. This started back in March when we were getting ready to do these updates, going, okay, how can we get more specific with income? And we spread out and asked multiple people, internal, external, and where are the bulk of your challenges? And resounding response was fluctuating hourly earnings. We said, okay, that's what we're going to focus on, and we did. The first thing we did, this is a small thing in the income calculation section of the guide. So the requirement is, and we're not talking about overtime, bonus, commission right now, we're just talking about the base earnings. You average the year to date and prior year. That's the basic of the basic. If you see the parens S in there, some people were thinking, well, average year to date prior year, if I have 2 years W-2s and a pay stub, that means that no matter what, I have to average 2 years in year to date. And sometimes that can really screw you up, especially if you're high DTI and things are tight. You don't have to do that unless you see something glaringly off about the deal, you know, as far as, well, 1 year was 20, 1 year was 40, you might want to question that. But other than that, we require a pay stub and the most recent year's W-2 for your base earnings for fluctuating hourly. We added is based on history and documentation requirements to clarify anybody who has that question of, do I really need to include that second W-2? The answer is, as long as something's not really off, no, you don't. You're basing your average of year-to-date and prior year on your history and your documentation requirements. Hopefully that all just made sense. And then the key piece of the update was the degree of fluctuation and your income trend analysis. So today, before these updates, before we published, we said your income's consistent for employed earnings if the degree of fluctuation is within 10% year over year or year over year to date. We went ahead and put some language in there. It was a little more specifically, which says just that, but that's no policy change. It was degree of fluctuation within 10%. You're good. You don't need to do anything else. This is the new piece. We didn't say anything once it heads over 10. We simply said you need additional analysis, maybe some additional documentation. So that's when you get into really vague, what should I do? And some people are just fine with that and others want more direction. So we took the chunk of the most obvious grouping of files. Once you start soaring over 30% year over year increase in this category, I think everyone needs to step back and go, okay, what's going on? Am I okay? But within the 10 to 30, it could be a great raise. It could be significant increase in overtime. It could be all kinds of different things that still make sense. So what we did is we took the 10 to 30% degree of fluctuation section, and then we added some underwriting guidance about raises, about splitting, verifying your split of your base versus your overtime. Do you combine it all or do you document the split? And we did a section on how to do that. And we said, if you do these things and you fall within the 10 to 30 bucket, you're still okay. Just follow the requirements in here. But we also said, while we're giving you some really basic underwriting requirements about raises and splitting overtime versus base, you don't have to do that. But if you don't do that, and you do have a higher degree of fluctuation, you need to ensure that whatever you do is fully supporting your stable monthly income, and you're back in the vague area again where there could be questions down the line. Let's flip to the next slide. So the underwriting guidance I'm talking about, there's two new sections which we're going to look at in a minute. One is really basic. When I'm trying to calculate income, what are the basic underwriting requirements for employed income that I need to think about? And I'm talking history requirements and documentation requirements, really basic stuff. And we thought maybe it would help if we put it all in a chart and put it right there in the income calculation section, because we all know the income section has got so much stuff in it. So we thought, let's take the basic primary requirements, throw them in here with links. That's that first piece. The second piece is the new underwriting guidance I'm talking about, where we added verbiage on pay frequency, some of which was already there, some of which is new. We added a section on how to document an income breakdown, how, when, why you'd normally do it, and the same story on raises. And with raises, what we did is another question came up. I saw feedback from numerous folks that said, if my borrower gets a raise last year, this year, and I want to average the hours, let's say somebody works a steady 36 hours a week, and you can verify they worked 36 hours a week last year, year to date. Folks didn't think that they could verify that and then apply the higher hourly rate to the 36 hours. We never said you couldn't. It's just that you're getting more into underwriting. It's not really requirements. So we didn't really speak to it in the guide. But some folks really thought you couldn't do that. So we said, okay, let's put in there that you can do that. And let's say exactly how to do that, because there's numerous ways you could do that. It's a little bit painful probably in some spots to do that. So if we are going to go down that road and you want to do that, here's exactly how you'd want to do it. And if you do that, and that's the reason for that large increase, then you're okay. Hopefully so far I'm making sense. Let's flip to the next slide. Okay, as far as basic requirements go, here's the first section where we said, okay, well, let's just give the most basic of basic requirements, where what do I really need to do when I start to calculate income, and if I need to go back and check, where are the links. So written income analysis, don't forget that one. Income documentation, I've got 3 different forms of income. I've got a VOE, I've got a pay stub, I've got a W-2, and I maybe have something else. And do all of those need to kind of correlate to each other? Yes, of course they do. If my VOE says one thing and my pay stub says something entirely different, that's not okay, regardless if it's excess documentation in the file. All of it needs to make sense. Your employment history requirements, there's a quick flip there. Generally, it's 2-year history. Another little tidbit is a lot of what I heard and saw, and realizing on the heels of COVID the last couple of years have been a little challenging. That could play into it, along with higher interest rates, et cetera, high DTIs. A lot of the loans we were getting questions on were less than 2 years employment. So you're already kind of in exception territory. So I think that's kind of, things will get more challenging, and we're never going to have guidelines that say what to do when you've got 3 months employment, 6 months employment, 9 months employment. Once you start doing that, you start restricting loans that perhaps don't need to be restricted. I won't say never, but that wasn't our desire with this update. And then your general stability and history requirements. So that's that. And then we'll go to the next slide. This is the section of the guide that I would suggest a good close look. This is a great section to kind of go, no, I don't want to look at that. But this is an important section, because in your 10 to 30% degree of fluctuation range, this is where we're telling you, okay, you don't have to do this. This is generally why you do it. See where it says, I've got a couple of underwriting spots, or underlined spots, excuse me. While a documentation breakdown is not required in all instances. And then you flip down to the next one. While documentation to verify pay raises are not required in all instances. These aren't things that you must do on every single file. You're only doing it when you're trying to offset something. Maybe you've got a 49.9 DTI and you want to get a little more income just to be safe. Maybe then you go to your documented income breakdown. Maybe you've got a year-to-date increase of 29%, and you're like, let me go ahead and work on this pay raise. And so you'd go into the pay raise section and do it that way. Option 2, bolded below, and we're not going to do this on this call. I think our folks from QC will give you a couple of examples here, but if you want to try to use an average of hours, there's where we tell you that as long as the income's consistent / increasing and the hours are same, then you could go ahead and apply that method to calculate your income. It would get you more income. And I think with that, we're done. Can we flip to the next slide? Yeah, we are. Okay, Matt, we're back over to Matt. Thank you very much.
Thanks, Mary. Yeah, great information there. Okay, so now I'd like to go ahead and share a common error we see in QC for borrowers that do have fluctuating hourly earnings. And I have a scenario here that represents that. So the scenario isn't anything new related to the bulletin, but it's still a very common defect that we see here in QC. So in this case, we have a pay stub. It reflects that the borrower is working 40 hours during this weekly pay period. Let's assume this borrower has been with the employer for at least the last 2 years. Now, many times we see the borrower working 40 hours and the income is calculated by essentially taking the hourly rate. So in this case, you have $23.75 per hour. Multiply it by 40, multiply it by 52, divide by 12, and you come up with the qualifying income of $4,117 per month in this case. However, you take a look at the year-to-date earnings, and it tells us that some further analysis really should have been completed here. So, if the borrower was working consistent 40-hour weeks at that rate, then the year-to-date earnings should be significantly more than the $29,510 that's reflected on the pay stub, as you can see. So the year-to-date earnings being this low, it could be indicative of the borrower working fluctuating hours, and in that case, the income would need to be averaged over year-to-date and previous year. So on the next screen here, we're reviewing the file and there's no other documentation provided as to why the earnings were so low.
So Matt, what type of documentation would be sufficient to justify using the base rate with those low year-to-date earnings?
Well, Amanda, every circumstance is a little unique, but an example would be a document from the employer that confirms the borrower is being on a leave of absence and details how long and how this impacted the year-to-date earnings, which could be sufficient justification to support using the base rate and then deem the borrower's income as non-fluctuating. So as we look at the guide section here, it's guide section 5303.2b, we see that if a borrower's earnings are to be classified as base non-fluctuating, that the qualifying monthly income must be fully supported by the documented year-to-date earnings on the pay stub. So really important to take a look at those year-to-date earnings.
That makes sense.
Okay. So now that we see the year-to-date earnings were not supporting the monthly income used to qualify, and there was no documentation in the file to reasonably explain why the year-to-date earnings were not supportive of the income, the earnings would need to be averaged, like I said, over year-to-date and previous year. That's per our guide section 5303.4b. And to calculate the qualifying income, with the documentation we have here, we're going to have to take the year-to-date earnings, which were 29,510, it's per the most recent pay stub. We add the 2022 W-2 earnings that you have here on the screen, shows 43,225, equals $72,735 total. So there's a total of 20 months of documented earnings. So the qualifying income will be calculated by dividing the 72,735 total by 20, and that yields the qualifying income of $3,637 per month.
Oh, that's a big difference than the 4,017 used to qualify.
It is, yeah. That's why it's important to make sure the year-to-date earnings are supportive of the monthly qualifying income. Just because you have one pay stub and it reflects 40 hours worked for that pay period, it may not be an accurate depiction of the average weekly hours worked. So, the lower income here in this case of $36.37 per month could be significant enough to possibly invalidate the LP approval. So.
Okay, Matt. So once it's established that a borrower is working fluctuating hours, should an average of year-to-date and previous year earnings always be utilized?
Yeah, good question, Amanda. Not always. Reviewing the income trending is also very important. As you can see here outlined in the guide section 5303.4b, when comparing the year-to-date earnings versus the previous year earnings, if there is a declining trend, then the average should be based off the year-to-date earnings and not include the higher earnings from the previous year in the calculation, unless the file is documented to reflect the lower year-to-date earnings were due to like a one-time occurrence, and it's outlined here in the guide section. So also, if the decline is greater than 10%, further analysis is required and should be obtained to deem that the income is being stable, as Mary mentioned earlier.
I see. So does that concept for trending and income stability also apply when there is an increase of greater than 10% from previous year to current year to date?
Yeah, it could, Amanda. As Mary mentioned earlier in our recent guide bulletin, if the increase in year-to-date earnings compared to the previous year exceeds 10%, then some additional analysis may be required to establish the increased earnings as being stable.
So if there was documentation in the file that confirms, let's say, the borrower received a pay raise in the current calendar year, would that be enough just to establish the stability?
That would be enough, yeah, because the documented pay raise now outlined in the bulletin, as you see here, would be sufficient and no further analysis would need to be required at that point. Good question.
Yeah, makes sense. So Matt, another question. If a borrower did receive a pay raise in the current calendar year, it seems to me like averaging the previous year's lower earnings in the calculation may not be the most accurate depiction of the borrower's income on like a go-forward basis.
Yeah, good observation, Amanda. If we can establish the average hours worked during the year-to-date and previous year time period, it is acceptable to utilize the current higher hourly wage and average the hours worked to calculate the income. Now, it does require a bit more work and documentation, but I do have an example here that's coming up. which is right here. And in this case, we have earnings documented with the written verification of employment form. We can see here the borrower received a $1.50 hour pay raise, and that was on March 1st of this year, 2023. We also see the employer documented the pay raise in the previous year, along with year-to-date earnings prior to the pay raise for both years, 2023 and 2022. So that's in section 20, as you can see down there, kind of in the bottom of the VOE right there. Section 20 is where it's broken out. So
is that enough information on this written VOE form to determine the average number of hours worked?
there is, Amanda. The key information is when the pay raise was given and what the earnings were prior to each raise.
That makes sense. And this could be documented with the pay stub information. Is that also correct?
Correct. Yes, it can. And the borrower would need to provide pay stubs documenting the pay raise and the stubs that reflect earnings in the pay period prior to the pay raise. So in this case, the borrower would need to provide the most recent year-to-date pay stub, 2022 year-end stub, along with the pay stubs for the pay period prior to and after any raises were received. So the specifics for this calculation are outlined in detail in the recent FAQ that came out with the bulletin that Mary spoke to earlier, and it's a great reference to use. Provides a good step-by-step calculation there.
Definitely.
Okay. So here on this screen, I'm going to provide the steps taken to calculate the average hours worked per month. So now, first step, you want to obtain the total earnings prior to the pay raise in 2023. So here we have the written VOE, broke it out for us, it reflected 75.83. We know the hourly rate at that time was $25 an hour. So you divide the 75.83 by 25, get you 303 hours worked. Next step, you want to determine the average hours worked after the pay raise. So what you do is you subtract the 2023 year-to-date earnings, which were 39,043, by the 2023 earnings prior to the pay raise, that was 75.83, leaves us with $31,460. Divide that by the new hourly rate, rather, the $26.50 an hour, and the average hours worked for that period is going to be 1,187. So you take those same calculations, you apply it for 2022, add all the hours worked, and you're going to get a total of 3,255 hours over the 22 months period of the documented earnings. So divide the total hours by 22, and the average hours worked per month is 148. So now you take that times the current hourly rate of $26.50 an hour, and the monthly income that can be used to qualify is $3,922 per month.
Wow, Matt, this calculation is a bit more complex than just taking an average of the year-to-date and previous year earnings, and it requires more documentation.
It is a bit more complex, does require more information, but in this same scenario, if you average the earnings instead of the hours, Amanda, the total qualifying income is going to be $3,760 per month. So, and that's an acceptable calculation, but it may not be enough to qualify, especially if you have a higher DTI loan.
Ah, I see. So that extra work pays off.
It does. It does.
Okay, so since we're averaging the hours, not the earnings, we still need to be aware of increasing trends, right, Matt?
We do, Amanda. Yeah, the same concept that applies. If you have a significant increase, could be an issue with the stability, and further analysis may need to be performed. As you can see in the scenario here, borrower's average monthly hours are on an increasing trend, and average hours worked in 2023 is 149 per month versus the 147 in 2022.
So what type of documentation would suffice if the hours were significantly higher in 2023?
Well, it's possible the borrower possibly took on more responsibility and is now consistently working more hours, and there is a letter from the employer documenting this in the file.
That makes sense. Thank you, Matt.
Okay, so now I'm going to go ahead and close it out with some key takeaways here for borrowers that have fluctuating employed income. So first, make sure the year-to-date earnings are analyzed One pay stub may reflect 40 hours worked, but the year-to-date earnings are not supportive of the income, and the borrower may have to be classified as a fluctuating hourly earner. If the borrower is to be classified as having fluctuating hourly income, be sure to analyze the trending. Look out for declining earnings or a large increase or decreasing trends year over year. May change the calculation or require further analysis and documentation. A written income analysis may be required in some situations. Typically, the more information you can provide, the better, I would say. And now averaging the hours worked can provide more qualifying income than averaging the earnings for fluctuating borrowers who received a raise in the current calendar year. Need to make sure there's enough information to do so. Specifically, when exactly the pay raise occurred and what the earnings were directly prior to the pay raise. Okay. So at this
Okay.
point, we'll open it up.
Thank you, Matt and Amanda. It looks like we have a couple questions. Again, if you have any questions for our speakers, please enter them in the Q&A box by clicking the three dots located in the bottom right-hand corner of your screen. All right, so first up, I think I have one for you, Matt. In terms of averaging the hours worked, would it be acceptable to just use box 15 on the written VOE, which states the average hours worked, rather than having to calculate the hours based on the earnings and pay rate?
Oh, yeah. Yeah, great question. Unfortunately, we would not be able to do that. It would not be an acceptable method of calculation. As you know, box 15, it may not be indicative of the current year-to-date average or the previous year's average hours. And we must analyze the year-to-date and previous year in order to comply with our guide section 5304 B, 5303.4B, I should say. And we have to determine if the hours are on an increasing or possibly even decreasing trend. So that's why using box 15 would not be an acceptable method of calculation. Great question, though.
Amazing, amazing. Okay, one more. Looks like I have another one for you while you're here.
Sure.
If the earnings are fluctuating hourly and a minimum number of hours worked per pay period, example 32 hours per week, is verified based on a review of the prior year and year-to-date income, is it acceptable to calculate weekly gross income using the verified minimum number of hours worked? Example 32 hours times $25 times 52 weeks per 12 months.
Okay, yeah, I see what you're saying. And yes, that would be an acceptable calculation. One thing you got to keep in mind, though, however, is we're still considering those types of borrowers as essentially being fluctuating hourly, and you need to have the 12-month history of receiving those earnings at that point. But yeah, good question.
Amazing. Thank you so much, Matt. All right, unfortunately, we are out of time for questions. However, we will follow up with everyone after the call. So just be patient while we go to that. Amanda, I will pass it back to you. Amanda, you are
You're
on
on mute.
mute.
Oh, okay. Sorry about that.
I figured
Talking
I'd
away
say
there.
something.
Thank you, Mary. I appreciate it. So, as a reminder, for additional information, we encourage you to take advantage of the training and resources available from the Freddie Mac Learning Center. The Customer Call Center provides seller servicer support Monday through Friday at 1-800-FREDDIE. And please visit the Freddie Mac Single Family website at sf.freddiemac.com and stay current with the resources there, including the Single Family Seller Servicer Guide at guide.freddiemac.com.
Right. Attendees, thank you so much for joining us today. I would like to remind you that we would love to hear your feedback. Please complete the post-event survey at the end of the webinar. The survey will pop up once you leave. Thank you in advance for taking the survey. Amanda, Rachel, Matt, and Mary, I will now hand it back to you.
Well, that ends our portion of the presentation for today. We hope you enjoyed this webinar and that you found it useful. And thank you to all of our clients who joined us today. As a reminder, for those of you that may have submitted questions, we will get back to you as soon as possible. Thank you all and enjoy the rest of your day.